In 1987, Wall Street had a new hero. He was 21 years old, worth $300 million on paper, and had just been on Oprah Winfrey. His carpet cleaning company was the hottest stock on the NASDAQ. Investors loved him. Banks trusted him. A Big 8 audit firm signed off on his numbers. There was just one problem. 90% of the entire business existed only on paper he had forged himself. Barry Minkow grew up in Reseda, California, watching his parents struggle to pay bills every month. He decided early that poverty was not his future. At 16, he launched a carpet cleaning business out of his parents' garage with 3 employees, 4 phones, and the kind of ambition that makes people uncomfortable. By 20, he was on the cover of financial magazines. America loves that story. A working-class kid builds something from nothing. Wall Street especially loves it when there's real money attached. But carpet cleaning doesn't make you $300 million. Barry knew that, so he invented something bigger. He told investors that Z-Best had a lucrative side business, insurance restoration. When a building burns down or floods, someone has to clean and repair it. Those contracts, Barry claimed, were worth tens of millions of dollars. He showed the revenue figures. The growth curve was extraordinary. Banks lined up to lend, investors lined up to buy. And on December 9, 1986, at just 20 years old, Barry Minkow became the youngest person in United States history to take a company public on the NASDAQ, raising $13.2 million in a single day. Within months, Z-Best hit a valuation of roughly $300 million. He appeared on the Oprah Winfrey Show, standing ovations at investor conferences. The kid from the garage had made it, except none of it was real. Here is how the fraud actually worked. Imagine you tell your bank you have $1 million client. They give you a loan based on that. You use the loan to pay off an older debt. Then you invent another client to justify the next loan, and so on. It works perfectly as long as nobody checks. 90% of Z-Best's reported profits came from insurance restoration contracts that did not exist. The clients were fake. The job sites were fake. The documents were forged with the help of a man named Tom Paget. When banks wanted to see evidence, Barry had an answer. When they wanted more detail, he had more paper. But then came the moment that should have ended everything much sooner. Ernst & Winnie, the firm auditing Z-Best's books, demanded to physically inspect a restoration job site. They wanted to walk through a real building. They wanted to see actual work happening. Barry did not panic. He found an empty building, rented it, hired actors to pose as workers, scattered construction equipment around, and gave the auditors a full choreographed tour. By the end of the day, the building was returned to its owner. The auditors went home satisfied. The fraud continued. To keep cash flowing between those theatrics, Barry had borrowed from a mob-connected figure named Jack Catane. That meant Z-Best was now entangled with organized crime, with criminal money flowing through a publicly traded NASDAQ company. The scheme required more deception every single month to survive. That is the trap. Fraud doesn't stay the same size. It has to grow or it collapses. It didn't start with a federal investigation. It started with one woman and one credit card. Years earlier, Barry had forged a customer's credit card number to fund the early days of the company. That woman eventually discovered it and filed a complaint. Investigators traced the card back to Minkow. The Los Angeles Times started asking questions. In mid-May of 1987, the paper published a story about Barry's history of credit card forgeries before the IPO. That was the crack. Ernst & Winnie started pushing for real answers on those restoration contracts. On June 2, 1987, they resigned as auditors. When a major audit firm walks away from a client mid-year, that is a fire alarm. Banks immediately canceled credit lines. A planned $40 million acquisition collapsed overnight. The stock lost 28% in a single session. The entire system Barry had built was held together by one thing: confidence. And confidence, once broken, does not come back. July 1987. Barry Minkow resigns. Z-Best files for bankruptcy. Police raid headquarters and find evidence of organized crime connections. The company, supposedly worth $300 million, is liquidated at auction for $64,000 total. In March of 1989, Berry was convicted on 57 counts, including racketeering, securities fraud, bank fraud, and money laundering. 25 years in federal prison. $26 million in restitution. Ordered investors lost more than $100 million. And then the story takes a turn nobody saw coming. After serving about 7.5 years, Berry was released. He became a pastor, then a fraud investigator. He worked with the Federal Bureau of Investigation to expose corporate misconduct. People forgot who he had been. In 2011, he pleaded guilty to stock fraud again, using his fraud investigator platform to publish false reports about a company called Lenner Corporation and help short sellers profit from the resulting stock drop. In 2014, a third guilty plea for stealing roughly $3 million from his own church congregation. 3 convictions, 3 frauds, one man who apparently could not stop. So what should investors have seen? The first signal was the growth itself. Z-Best's revenues grew nearly 400% in a single year in a stable, unsexy industry like carpet cleaning. When a company grows that fast without a clear structural reason, that's not genius. That's a question that demands a real answer before you write a check. The second signal was the gap between profits and cash. Berry's income statement looked great. His cash flow was always in crisis. Profits on paper can be invented. Cash actually entering a bank account from independent clients is much harder to fake. When a company consistently reports profits but cash from operations is negative or zero, something is wrong. This exact pattern appeared at Enron. It appears in almost every major fraud. Always check the cash flow statement, not just the headline number. The third signal was auditor independence. Ernst & Winnie partners were attending social events hosted by Berry Minkow. When auditors become friendly with the people they audit, objectivity disappears. Check how long the same audit partner has served the same client and whether the auditor has any personal connection to management. That information is in public filings. The fourth lesson is for founders. Berry didn't start as a master criminal. He started with one small lie to cover one small cash shortfall. Then that lie needed a bigger lie to protect it. Then mob money. Then fake construction sites. The fraud had to keep growing or it would die, which means its collapse was never a possibility. It was a scheduled event. Build your company on real numbers, even when real numbers are painful, because the alternative always ends the same way. Financial fraud doesn't change its nature, it only changes its costume. The next one is already happening somewhere. Subscribe so you catch it before the crash. Every week, another billion-dollar lie gets closer to its expiration date. If this case taught you something, drop a like, and if you want to see the same playbook executed on a much larger scale. The Enron collapse is next on screen.